So in this video, I'm going to be going over everything you need to know about FHA loans, the complete guide for first-time homebuyers, even if it's not your first rodeo. And if you're new to my channel, my name is Meredith. I'm a mortgage broker. I put out educational videos every single week on tips about home buying and tips on home ownership. So hit that subscribe button so you can get notified every time I put a video out. Okay, so here's a general overview of FHA. FHA loan, it's a government loan. It's actually insured and backed by the department, HUD, and it insures the lender. And the reason for this is this loan is designed, it's more flexible. So it's designed for those that have normally a low to moderate credit score that can't normally get approved by conventional loan. And they did this to help boost home ownership in the US. And it's not for first-time homebuyers only. This is a big myth. A lot of people think you have to be a first-time homebuyer to use this. No, you can be a second homebuyer. I mean, you can use this many times. And also, what's cool about this loan is you can also use an FHA loan to build a house and also renovate the house as well. So that's a really cool feature of this loan. Okay, so as far as the down payment goes, the minimum down payment for this loan is 3.5% of the purchase price. Now, here are some acceptable places where you can get the down payment. You can use a 401k loan, you can use home equity line of credit, and you can get a gift from a family member. You can also use this with, you can get a down payment for local down payment assistance programs or even federal down payment assistance programs. Although those are very usually costly loan programs. What you can't use for the down payment is any like unsecured loan, any credit card, any personal loan, and you cannot use cash because we have to source the funds. Now, as far as credit score goes, this also plays into the down payment. One of the biggest perks with FHA is you can have a lower credit score. So it can go down to a 580, sometimes even less, but you do need to have strong factors that compensate it. So usually with a 580, you normally have to put down more than the minimum 3.5%. And you're going to get killed on the interest rate. There's going to be a lot of fees. It's going to be very costly with a 580 score. So generally speaking, you want to get your credit score up to at least a 620. That's going to be the next benchmark. At a 620, the minimum score is a 3.5% down payment. And again, this is probably one of the most benefits for doing an FHA loan is they accept lower credit scores. So generally speaking, this is going to be the best option if you have like a 680 or below credit score. Okay, so as far as major credit events, here's a list of a couple, and I wanted you to see the difference between conventional and FHA, and you can see here how much more flexible as terms of the length of time you have to wait to buy your next house. So if you have a foreclosure for an FHA loan, you only need to wait 3 years. With a conventional, you have to wait a full 7 years. Now, with a bankruptcy, if you have a Chapter 7, you need to only wait 2 years. If you did a Chapter 13, you only have to wait 1 year. With conventional, you have to wait about 4 years for each event. And with a short sale, with FHA, you only have to wait 3 years, with conventional 4 years. So as you can see here, this is why they designed this program to help those get into houses to help boost homeownership. Okay, so let's go over mortgage insurance because this is by far the biggest downside to having an FHA loan. And the reason they have this mortgage insurance is to help insure the lender and to keep the FHA loan program going. And there's two ways that you're paying mortgage insurance, and it's really important for you to know this because a lot of lenders, they don't explain it to customers or they don't even know really how to explain it to customers. So number one is you're paying for it up front. And when I say up front, what it is it's wrapped into the loan amount. So you're not having to pay for it directly in the cash, and it's a set percentage. So what they do is it's 1.75% of the loan amount, and they add that back into the loan. So let's say you're buying, your loan amount is $300K. With the upfront mortgage insurance, that mortgage insurance premium is going to be $5,250, and they just add this to your loan amount. So your monthly payments are going to be based on the $305,250. Now, there's a second way that you're paying mortgage insurance premium. It is on a monthly base as well. And it's also a set percentage. So based on this loan amount, you will be paying about $137 a month, which is added to your mortgage payment. So again, there's two ways that you're paying the mortgage insurance premium. This is why FHA is not really a long-term plan, because this mortgage insurance premium, it always stays on the life of the loan. You'll always be paying paying on it, and it will never drop off like it does on a conventional loan. Okay, so let's talk about employment. So you will need to have a job history for the last 2 years. So 2-year work history. It doesn't have to be with the same job or even in the same line of work, but you do need to have had a job for at least 2 years with a very minimal gap between the jobs. And if you are a W-2 employee, what they'll ask you for is the last 30 days of pay stubs, your W-2 for the last 2 years of all of your jobs that you worked out. Now, if you're self-employed, it's a little bit different. And self-employed is if you own your own business or you are a 1099 contractual work. And what they do is they will ask for your last 2 years of filed tax returns. And how they calculate your income is they look at your income minus all your expenses, your write-off deductions, and then from there, after subtracting that will be your taxable income. And they look at your taxable income for the last 2 years and pretty much divide that by 24 months, which is 2 years. And that's how they get your actual income. So it's very important that you work with a good CPA. You tell them up front, hey, I'm looking to buy a house, and they will help you from there. Okay, so let's talk about debt to income ratio. Now, you'll hear this, lenders talk about this all the time. And basically what this is, it's a percentage. It's how much of your income is going towards your monthly income is going towards all of your monthly debt. So with FHA, they'll allow you to have 56% of your income go towards your debt. Now, it's important to note, just because the bank allows you to lend this much, or even if they give you a loan for X amount, doesn't mean you have to take it. You know your situation best. You know how much you can afford. So what all do they qualify as monthly debt? So it's basically like car payments, student loans, credit card bills. It's also the future monthly mortgage payment. They take that into consideration. And it's also child support, alimony. Things they don't look at is like how much you pay in rent. They don't consider that as a monthly debt. They don't consider utility bills, cell phone bills, things like that. They don't look at as monthly debt. Okay, so here's how they calculate your debt to income ratio. So what they first do is they add up all of your monthly debt, so all of the monthly payments. They also include your future mortgage payment as well into that lump sum. Then they divide it by your monthly income, and it's important to note they're using your gross monthly income, not your net. Then to get the actual percentage amount, they multiply it by 100 to get the percentage. So let's just do a hypothetical example. Let's say you have about $2,000 of monthly debt, all added up from car payments, student loan, credit card monthly payments, etc. And then on average, let's say the mortgage payment on about a $350,000 house is going to be around right under $3,000. That's including taxes, insurance, mortgage insurance out the door. So we add up your monthly debt plus the mortgage payment, your future mortgage payment. So in this scenario, that will give you $4,920. Then then you divide it by your income. Let's say your household income is $9,000 a month. So you divide the debt divided by the income, and that equals 0.46 times 100, and it roughly rounds up to 55% debt to income ratio. Okay, so as far as property requirements goes, you must use FHA loan to buy your primary residence. You must live in that. If you're wanting to rent it out in the future, you must live in there for at least 1 year. And what's really cool about this loan is you can use it to buy single family house, duplex, triplex, quadplex. You can go up to 2 to 4 units, and you can also use the rental income to help qualify you for buying a duplex, triplex, quadplex. So this is a really cool feature. As long as you live in one of the units, you can buy a multi-unit property with 3.5% down and already have an income producing property. Now, with condos, you must get this, it must be approved by FHA. They look at a lot of things with condos. A lot of times condos are really hard to get with an FHA loan because there's very strict requirements on there. Okay, so as far as appraisal requirements, so the house must pass health and safety requirements, and the appraisal is normally, it is stricter than a conventional loan. And you have to think of it, the house almost has to be move-in ready for it to pass the appraisal. Now, if the appraiser finds something that needs to be fixed or addressed, the seller will actually have to fix that. They'll have to get a licensed contractor to fix all the issues. And this is why a lot of sellers do not like to deal with FHA loans. That's why normally conventional loans are more appealing to sellers, because what happens is the appraisal finds something on there. A lot of times, here's a list of issues. It could be roof, plumbing, rotten wood, exposed wiring, broken glass, broken windows, like major issues with the air conditioning. And if the appraisal finds it, it must be fixed before you can close on the home. Okay, so here's a good strategy on how to use this loan. Use the FHA loan to get into the house, maybe buy a duplex, quadplex, whatever the case may be, and you can have the seller pay for your closing costs. With this loan, they'll allow you to go up to 6%. The seller can give you 6% of the purchase price to use towards your closing costs. So on a $300,000 purchase price of a home, the seller can give you $18,000 towards your closing costs. And you want to use this money to buy down the interest rate, get a lot lower interest rate so you have a comfortable mortgage payment. And then after you buy the house, work on your credit, build up your credit. Having a mortgage on your credit history will also help boost the score over time, because after that, then you'll want to refinance into a conventional loan so you're not paying the mortgage insurance for the life of the loan. So again, this FHA is a short-term plan to get you into the house. Remember, it's designed to help those lower to moderate credit scores get into the homeownership game. So here's how to apply. So you don't directly apply to FHA to get this loan product. They don't directly lend to the public. You'll have to apply with either a mortgage broker, credit union, direct lender, or bank. And here's kind of the key differences between all three is when you go to a credit union or you go to an actual bank, you're going directly to them. They pull your credit, you do one application, and you're stuck with the interest rate that they're offering. You're also stuck with their loan products and their underwriting. And if for some reason they can't do the loan, they end up denying it, then you have to go somewhere else and start over. That's the same thing. Credit union and the bank, pretty much the same thing. Now with a mortgage broker, what they do is with one credit pool and one application, they shop the rate for you. They find you the best program, and they pretty much are doing the work for you. So in a case, if you get denied, they just go to the next bank. You're not having to start all over at another place. And this is what I am. I'm a mortgage broker. So if you have any questions, if you wanting any guidance on getting an FHA loan or home buying, click the link. It's in my description. You can schedule a free call directly with me. And I hope you found this video helpful, and I'll see you on the next one.